Great bio that you just gave me. That's me accomplishments. It's humbling. So good afternoon, everyone. I believe everyone is right here in North America, so it's okay to say good afternoon. I'll share my screen if that's okay. Yeah, hold on, I have a presentation slide, which I will just share. Yeah, I was having technology issues earlier. That's why I kind of joined a few minutes late too. But okay, yeah, it's up now. Hold on. Sure. Hopefully I don't share the wrong thing. Let me know when you guys can see the screen.
Yeah.
Okay. Yeah. And I also want to, okay, I'm not used to this Zoom. I want to use the slideshow. Okay, cool. Now I got it. Everyone can see the page, right? When I flip through, correct? Okay, good. All right, so I won't take too long talking about this because I want this to be very interactive. And Yinka, do you want people to ask questions as I go along, or do you want me to just go through real quick and then people can ask questions after? What do you prefer?
Yeah, I think that's the plan, Grace, for you to go through what you have, and then people can ask questions afterwards.
Okay, all right. I'll try not.
Also in the chat box.
Okay, yeah, I'll try not to take too long doing this, but I mean, you could take note as you like. I want to cover several sort of asset classes today, and I'm assuming people don't know much about investment, so I will make it as layman as possible. But part of the things I want to consider is real estate. I'll consider crypto. I know it's interesting that I started talking about crypto these days, because if it was last year, you wouldn't have heard me talk a lot about that, but it's interesting to talk about it now. I'll talk about stocks, you know, and other sort of investment like bonds, ETFs, derivatives. And I'll talk a bit about agriculture because Yinka said people are interested in hearing about that. And I'll give you my views on that as well. And then talk about retirement plans and what I think people can do and sort of low-hanging fruit to like build wealth. Okay, so those are the major topics I want to discuss. So I want to start real estate first because this is an easy one, and I think a lot of people actually have done it at least once, you know, in their lifetime, or will probably do it when they get their first house. But I'm looking at it now from an investment perspective and not necessarily the sort of house you want to live in. What I want to start with here is to say what to consider when you're looking at real estate as an investment. My simple rule when I want to invest in real estate is what I call the 1% rule. And I'll tell you what I mean by that. So if you want to buy a property, two things you look out for is how much cash flow you can get out of that property, which is typically the rent, and how much you're going to pay for it, which is the price of that property. The 1% rule basically says that if the rent, once you divide the rent over the price you're paying, if it's more than 1%, then it's expensive. It's kind of getting expensive, slightly. I mean, the 1% is not cast in stone. It could be like 0.9, it could be 1.1, but that's a general range to consider. I mean, if you see 2%, that's a really good deal. But if you start going to like 0.5, it's an expensive property. I don't know if that logic makes sense, but we can get into more of that details later on. So that's one way to sort of, it's just a rule of thumb to look at real estate to say, okay, nah, it's not making sense. And I know people who live in Toronto these days can vouch for that, that the prices there don't make that much sense to me when I've looked at it, because it's just gone up a lot and diverged from sort of the rental income. The other thing to consider in real estate is what we call cap rates, or sort of capitalization ratio, right? So what that is essentially,
Sorry, Tunde, is like someone wants you to go over that 1% rule again.
Okay, cool.
Yeah.
All right. So basically the 1% rule is just a very easy benchmark to assess whether a property is a good investment or not, right? And what you do is you look at the rents you can collect from that property in a month, right? So, and let me just use a real example now. You want to buy a property, it's $100,000, right? If you look at the rent you can get on that property and it's $1,000 a month, that's a good deal. That's a 1% rule that I'm talking about, right? So that's the benchmark. If you can get $1,200 a month on a property that's costing you $100,000, that's a better deal because that's 1.2%. So that's more than 1%, right? So that's a good deal. So the 1% rule is sort of like the minimum you should be, the minimum hurdle you should be trying to achieve when trying to invest in a property. But if you're trying to buy $100,000 property and the rent you can get on it on a month is $500, then that's not, you're not going to make money out of that property. Does that make sense now?
Yeah, is that also the same as the return on investment?
That is the return on investment. But we'll get into more of the return on investment on the next one I want to talk about. But that's where you start from, because the return also has to take into consideration your costs too. And that's what I was going to talk about in the next one, which is when I talk about the cap rate, right? So the cap rate is basically what I just explained now, which is the rent. What I just explained now is what you call the rental yield, right? So it's just your rent divided by the value of the property that you're buying. But the 1% rule is just looking at the rent for just 1 month, right? For the cap rate, which is the return on investment you're talking about now, it's calculated a little differently because now you look at the rent for the whole year. So in this case, let's use the same example, right? You're collecting $1,000 rent, right, on a property, and you multiply that by 12, which is a full year, right? And that will give you $12,000 a year, right? So that's your rental yield on that property is 12%, correct? Are we on the same page in that calculation, right? Because the property costs you $100,000, all right? Then remember, you have different maintenance costs for maintaining that property. You change stuff, the routine cost that you build into that. You take that out of your rental because it's a cost to you for having that property. Once you take that out, that's what you call the cap rate. That's your return on investment now. So it's still your rent, but you have to remember there's a cost that you're going to bear as well for maintaining that property over time. It might not be every month, depending on how new the property is, but there's going to be costs associated with maintaining the real estate. So it's not free lunch. So the cap rate is your return on investment on that real estate property, all right? You have to compare that with your mortgage rate. Don't put mortgage rate in that expenses because that will be calculating wrongly. You have to compare, because the cap rate is assuming you have the cash and you're investing it, you're not borrowing any money from any bank. But you have to compare your return on investment in that case, which you've calculated this way, to your mortgage rate, and you have to break even. It has to be higher for that property to make sense. Are we all on the same page? So what I've calculated to you right now is 12% rental yield. Let's assume your operating expenses for that property, when you calculate it for the whole year, is 2%. Just throwing out a number. I mean, depending on what the number, depending on what a property. So that means your return on investment annually on that property is 10%, correct? You have to compare that to your mortgage rate. What are you paying? Depending on your credit worthiness, you could be paying, 3%, 6%. So you have to compare that to know whether the property makes sense to buy and whether it makes sense to even borrow to buy that property. The other thing I want to talk about on real estate is that it's very tax friendly. So forget everything I've talked about now, in almost every developed country in the world, there's tax deductibility for having for real estate expenses, depreciation, your interest costs are usually tax deductible. Even sometimes your property taxes, which will be part of the operating expenses I talked about earlier, is tax deductible. So you get some tax deduction from it. So that's also cash into your pocket, depending on your tax rate. So it's tax friendly. Another good thing about real estate is it protects against inflation. It's a very good inflation hedge. Now that, we're all experiencing inflation globally now. It's the worst place you want to be is cash. A very good place to be is real estate right now, because it generally moves in line with inflation and protects the value of your money over a long period of time. Not to say property don't crash, they do crash, and they go up and down as well. But over the long run, it protects you against inflation. And you can use it to borrow money. There's what you call home equity loans. So which basically, you bought a house for $100,000, you've paid, let's say $30,000 out of it over years. You can actually go to the bank and borrow that particular amount of money that the equity you've already built in the home. You can actually borrow it out again as funds and go use it to do some other things. So it's you can leverage it for funds, and you can use it as a collateral to borrow money in the bank for other things too. So that's a good asset. But that's why I put this as the last thing, is that don't just buy real estate for the fun of it. You have to look at all these numbers that I had mentioned and make sure it makes sense. Because if you buy at any price, what I tell you is the only control you have is how much you pay for it. Once you bought that property, there's nothing under your control anymore. Things can change, market can move against you. There are other risks as well, having a bad tenant, all the stuff. So don't buy at any price. Make sure the numbers make sense. I just gave you kind of a rough estimate of how to look at it here, and we can talk a lot more about it later on. But I think in general, this is a good framework for looking at real estate as an investment. And even if you want to live in it, it's also a good practice to make sure you're not overpaying for property as well. The next one I want to talk about real quick. Sorry, why is this thing not moving?
Maybe okay. Before we move to maybe the next one, we have some questions here.
You have a question? Okay, good.
Yeah,
let's run
so
through
one person said, I'm wondering, lots of properties go for around 800K to $1 million, right? So how realistic is it getting a 10K rental income on that per month?
Yeah. That's a good point. I know, and I just made that joke about the Toronto market, right? Because my sister lives in Canada, and I knew when she was looking at properties, and I was telling her, these numbers are not making sense to me. Some real estate markets are not realistic, and New York is one of it. I live in New York City. It just doesn't make much sense, because real estate markets also get into bubble territory, where everybody's just in a race, to get properties, and people start having narratives around it. Oh, it's population growth, it's migration. They start justifying why it's worth that amount. I'm not saying don't buy a $1 million property if you can afford it. Why not? You don't have to make money out of it if you just want to live in there. But if you buy a $1 million property, better be sure that somebody can rent it for $10,000. There are people who rent places for $10,000. There are apartments in New York City that cost $10,000. So it's realistic. You can get $10,000 for a $1 million property. If you're not getting that, then it's expensive. That's just what it is. And do you want to pay $1 million? By all means for it. It might make sense to you. if you can afford it. Because even if you think about a $1 million property, right? If you calculate your mortgage, your taxes, and all of that on a $1 million property, it's not going to be cheap as well, right? So you better be able to get a good rental yield on it. Otherwise, it won't make sense for you. But if you can afford it, you earn good salary, you want to live in that property because it has other values to you. Let's say, the location is where you want to be, is close to work, or there might be other reasons why you want to buy. beyond just financial reasons, then do it. But I think that 1% rule makes sense. And if you're buying a $1 million property for an investment, yeah, you should try to make sure the rent you can get in that area should be around that area per month. Yeah.
Okay, another question we have is, what's the difference or benefits in investing in real estate in your personal name or in a company?
Oh, that's a good question. That's actually a very good question, because I didn't talk about that earlier. So it's more beneficial to do it as a corporate entity. You save more taxes than doing it in your personal name, and generally you get a lot more opportunity to have deductions for tax purposes. So all your operating expenses and stuff, you can lump it up because it's a company. Salary, all that stuff. You can even say, oh, I drove somewhere. So all your gasoline bills, you can put it in it and write it off. And it will be legal if you do it as a corporate entity. The only thing is, though, if you're doing it as a corporate entity, though, it has to be investment property. You can't buy the house you want to live in and put it on a corporate name. But as an investment, which is what we're talking about now, it's always a good idea to set up an LLP and then put all your properties in it. It will save you on taxes, because then it will be taxed. Whatever rental income you make, it will be taxed at the corporate tax rate and not your personal income tax rate. And for the most part, the corporate tax rates are lower. So that's a good question. And so you should always consider that, especially if you're looking to build a portfolio of investment properties. It's a good idea to put all of them together in an LLC. Any more, or should I?
Oh, no. You can come.
Okay, good. Thanks. So the next one I wanted to talk about is this is my area of core competence that I've been doing for pretty much all my life. Is stocks, mutual funds, ETFs, and I'll start with those ones. So I'm sure most of the people on here are familiar with what stocks are, shares in a company. So those are basically interest or securities in a company, and the company could be any industry, could be manufacturing, could be tech, it could be financial company, banks, whatever, it doesn't matter, but it's just you have an interest, so you're a shareholder in that company. And stocks are basically securities of those companies that are publicly listed and they trade every day on the stock exchange. So they're very liquid, which means you can get in and out same day, typically. And so they provide good source of liquidity when you need it. They are good inflation hedge, not as good as real estate in terms of inflation hedge, but over the long term, research has shown that stocks serve a good protection of value in terms of inflation. But it's always a good idea to put some of your wealth in the stock market as opposed to putting in cash. I mean, the U.S. stock market, for instance, use the S&P 500 as a proxy. It's been up by like 13% annually over the last decade. And I think I don't see any reason why it won't continue that way, because the Federal Reserve just keep bailing us out, and we can get into all of that details if you want to, but I don't want to bore you with all those technical stuff. But I always recommend buying stocks, and the way to do that is create a brokerage account and start playing around with it first. I use TD Ameritrade, but people can use whichever one. There are many of them. There's why am I having brain freeze right now? There's another big one that I just forgot now.
Well, Simple?
No, start with a C. Anyway, I'll remember over time. But there's so many. There's Robinhood. There's so many platforms, you can use. Fidelity, they're all pretty much the same, to be honest with you. And none of them charge any fee for trading stocks anymore, because competition has driven that whole brokerage fee away. So it's free to trade stocks, can go in and out without paying anything. So they make money in other ways, security lending and all the stuff, but you don't have to pay to buy and sell your stocks. But what I always recommend for people is buy into companies you've done a bit of research into. And I understand not everybody has accounting background and can do financial statement analysis, but if you want to invest in stocks, you should at least understand the company a little bit and what they do, right? And so, for instance, I'm very big on tech companies. I like technology because it just fascinates me, and I feel like they're our future. I mean, the way we interact with everything, Zoom, all this stuff, right? I just feel like, these are companies that are going to grow for a long period of time. So I do my research, understand their products, understand what they do, make sure they're profitable, because, a lot of times I see people just buy anything, very unprofitable companies, and just, they don't know what they're doing. So at least check whether, it's a profitable company, like Apple, like Facebook, whatever. And so buy quality growth companies and hold them for a long time. And the reason why I'm making this emphasis is that when you buy a quality growth company, even if you buy it at a high price, the moment it continues growing, that growth will create value for you over time. In investment, we call it value compounder, right? So, and that's why I emphasize growth. Because if it's not growing, then okay, they can be paying you dividend, but you might not make a lot of money on that stocks. But once it keeps growing and its cash flows are growing, the revenues are growing, the company is finding new sources of income. And, just use Amazon as an example, right? They just keep coming up with new stuff, right? Today, they're getting into healthcare. Tomorrow they're getting into another area. So they're always finding new ways to grow. And those are the companies that will make you a lot of money over time. And we can get into specific stocks and stuff if you want to, but I just wanted to give you a sense of framework or how to look at it in general and where to look for it. And just go into the brokerage trading platform, and their research is there, read about the company, what they do, whatever you can find there. And you can also kind of do dummy trading without using real money first to start, to see how comfortable you are, and then start with small amount of money. You don't need thousands of dollars to start trading stocks. That's a good thing. You can start your portfolio with $500, whatever you have, and see your tolerance for risk. I personally don't look at it every day because I don't need the money today, so I don't need to care about it. But it's interesting when you look at these things years after, how it's just created value for you without doing anything. So I always encourage you, why not? And especially as Black people, it's important for us to start creating wealth and thinking about, intergenerational transfers, which I'll talk a little bit much about later as well. So that's one, investing directly in stocks, because a lot of people don't have the time to do the research to invest in stocks directly. A good idea is, I don't want to do anything, I don't want to worry about any stocks. Then you can consider ETFs, which is exchange traded funds, or mutual funds. And I'll tell you the difference between the two. They're very similar in terms of the structure, but there's also nuances that makes them a little different. So what are these ETFs and mutual funds? They're basically funds. And they're funds that just hold a portfolio of stocks, right? So somebody else chooses those stocks in that fund on your behalf. So you are buying into that fund and say, you know what, I don't want to deal with picking individual stocks. I'll just buy a fund. And so there are two types now. Let's start with the first one, the exchange traded funds, right? These are like passively traded. These are passive funds. And when I say passive, it means that there's no particular manager like me that is picking the stocks and managing it every day and buying and selling. So it's just basically mirroring a particular index. So, and I'll give you an example because I know I can get technical here, and please, I'm willing to take as many questions as you want, but I want to make sure I dumb it down as much as I can. So basically it's like S&P 500 has like the top 500 companies in America, right? You can buy a fund that tracks S&P 500. So it has all these companies, big corporations in America in that S&P 500. And you can see everything in that S&P 500, but you own everything there by just buying one ETF. So an example of that is SPX, which is the SPDR ETF. It tracks the S&P 500. You can buy that and just have exposure to S&P. So when you watch the TV and hear, well, S&P is up today 0.5%, you just make 0.5% on owning that, that fund. So it's not traded by any portfolio manager. It's just basically buying a bunch of stocks that are owned in that fund, right? I don't know if that makes sense. So if I want to have exposure to the US market, S&P 500 is very good. So I'm like, okay, I just want to have exposure to the US market, right? In general, because S&P has all kinds of companies in it, right? Or I could be like, no, I want to have exposure to oil because I like oil, right? And you just buy an ETF that has exposure to oil. You can just Google it straight in your brokerage account and you find one that you like. It will probably give you a lot of options. You can read them, see what's different. Some might have a lower fee, one might have higher fee, you might choose the one with the lowest fee, which makes sense to you, and then buy, right? Or I might be like, I want, for instance, personally, I own ETFs that have exposure to semiconductors, or I have ETFs, I have exposure to tech, right? Because I just don't want to pick one. I want to have exposure to all of these fascinating tech companies, right? Or I might have exposure to ETF that just tracks financials like banks. So basically, just choose a theme that you think is interesting in the future, or you can buy ETF that is linked to crypto. So there's all kinds of ETFs that you can invest in, that whichever one makes sense to you, that doesn't involve you buying individual stocks. So you don't want to deal with owning it. You just want to own a bunch of them by just buying one of these funds, right? So ETFs are cheaper just because nobody is managing it, so they don't need to pay big salaries to anyone. But also they're just following a particular theme. There's nobody actively managing it for you. They also trade all through the day, right? So you can actually see your ETF price moving every day. I mean, during the trading hours. That's a big difference between the ETFs and the mutual funds. The mutual fund is the kind of fund that I manage, for instance. So I'm a portfolio manager on 2 mutual funds at my company. And that involves active management. Like I wake up every day and look at my portfolio and I'm buying and I'm selling because I'm trying to do better than the ETF. It doesn't mean I'm always successful doing that, but that's always my goal because my clients are paying me higher fees to manage a mutual fund than they will pay for an ETF. So I better do better, otherwise he's going to fire me. So I'm living every day to make sure I do better than that ETF. So in general, mutual fund managers will tell you they will do better. I mean, obviously, otherwise we won't be in business. But not all the time. So it's not a guarantee. And if they don't, they're not going to cut you any check. You can just fire them and take your money. But if you just want to be like, I don't want no human being doing it, I don't trust anybody, just buy ETFs then in that case. But that's the big difference between the two. But the main similarity is they hold the portfolio of stocks and someone else just do the work on your behalf. You don't have to worry about specific one. And nothing stops you from owning both. I own stocks and I own funds as well. And you can make money in both ways. But I'm just saying there are different trade-offs for doing both. The other thing is to leave your money in cash and do nothing. My view is in today's world, that is kind of stupid because cash today earns literally nothing. I mean, if you're lucky today, your bank pays you 0.2%. And if you add inflation on top of that, you're actually, losing money. So you have a negative inflation adjusted return. And the same for bonds as well. Bonds as well as like you don't make any money, the money market and the bond market these days. I mean, that could change in the future, but today it's not a good source of building wealth. So, and that's why I put it there as an option. But that's somebody who doesn't want to take any risk. Or, I mean, if you need your money to pay for something, yes, leave it in cash. Don't put it in stocks if you need to pay your rent next month, or if you need to pay your school fees, you can't, because these are more long-term investment opportunities I'm talking about, and not necessarily money that you need to spend for your operating lifestyle. And the last one, which I won't go into any technical details here because it's not my expertise. I understand it, but I don't personally trade it. It's derivatives, like options, swaps, futures, all kinds of exotic stuff. I call them time bomb, and I put that there on purpose because you have to have real technical expertise to make money out of that consistently. I mean, you see people from time to time who post things on their social media like, oh, I just made, 50% today trading this option, but they won't post it when they lose a lot of money trading the same options. It's very volatile. It's very technical. I generally don't advise it for somebody who's just starting. This is literally for traders, not for people who want to do long-term investing. And I don't do it personally because I have to go through compliance for all my trading. So I don't want to be going in and out and stuff. And I just generally tell people not to kind of avoid it if you can. But people can make money out of it. So it's something to consider if you want to do it. There's so many books you can buy. If you want me to give you a recommendation of books, I can give you can read it. And you can trade options. You can trade stock options, index options, all kind of options, and you can make money doing that as well. So I just wanted to make sure I mentioned that as another outlet for your wealth. Are there questions on this, or should I jump? Yeah.
Yeah, the questions, but I think I'll go back to real estate first, and then we'll
Okay. Okay. There's still more question on real estate.
So just one question for that. So someone is saying, if I'm interested in JV with someone abroad, what are the laws I need to consider before taking JV funds for real estate from abroad?
Wow, I'm not a lawyer, so I have to qualify whatever opinion or I give on that situation. I mean, if you want to go into JV with someone, what are the laws you need to consider? I mean, you have to follow the law of that particular country. I know Canada, for instance, doesn't, they don't allow foreign, and I don't know if it's all the provinces, but I know generally in Ontario, they don't allow foreign money into the system. And if you bring in foreign money to buy real estate, they tax you sort of a speculative tax rate, and it's pretty high. So that needs to be put into consideration when you're doing it, because then if you try to circumvent that and do it backdoor, if you get caught, you'll get in trouble. But I mean, in general, this would be a better question for someone who's into real estate law than myself. Not let me not give a bad advice or something that I'm not an expert in.
Okay, thank you for that.
Yeah.
And then another question, if you have questions, you can also unmute, but then another question regarding stocks here.
Okay, cool.
Funds here. So what are the active technical indicators to watch when picking good stocks or mutual funds?
Or mutual fund, okay. Yeah, so for stocks, I would say there's so many things you can look at for stocks, it's endless. But I'll just maybe pick up some like very quick pointers on stuff you should that could help you. So one thing that I always tell beginners to look at is, what is the price earnings ratio? We call it PE ratio, price to earnings. And what is that? It's basically, and every stock you go into your brokerage platform and you look at would always have all of those metrics for you to look at, because it's pretty standard. But price earnings ratio is basically comparing the price in which it's trading, which is the price in which you're going to buy it, comparing to the profit that the company made the last financial year, right? And the broad rule of thumb is to compare that number. That number could be anything. That number could be 10. It could be, for some companies, 80, so it varies widely, right? But the rule of thumb is to compare that number to how fast the company is growing. And you can see the growth rate of the company as well. Sure, those are like public information. They will be on the platform. So the rule of thumb is you should at least be consistent. So the same way I gave you that 1% rule of thumb for real estate is something similar here, right? So when you compare the price to earnings, which is a PE ratio, and is, let's say 20, right? 20 times. And the company is growing at 25%. That looks like a good deal to me because it's growing faster than that PE ratio. That looks like a good, it doesn't necessarily mean it's automatically a good investment, but that's a good place to start. So I said, that's interesting. Why is that? What are people missing? It could just be a good deal and you just found it, or it could be because some problem is about to happen that you didn't know, or you didn't. So you have to still do your research and read about the company and whatnot. But that's a very good starting point to compare that, to see how fast it's growing. And I said earlier that when a company is growing, it actually bails you out. It compounds value over time. Like, you'll be shocked how much money you make from all these very high rapid growth companies, which is why a lot of times when you look at their P ratio, they're also high because they're growing fast. But the fact that it's high doesn't necessarily mean it's bad. And the fact that the P ratio is low too doesn't mean it's good, because it could be low. It could be trading at 5 times, but that's because the company is not growing, or the company is going dead, is BlackBerry that is going to go into extinction or something. So you also have to do a bit more research to determine whether you feel like the growth is going to be sustained over time. So I would say that's one very good sort of technical indicator to look at for in stocks. Another thing, this is just commonsensical, right? After a stock has fallen a lot, it's always a good time to buy, in my view. Not all the time, but when it's falling compared to the history, because there's one bad news, usually that's when I get interested, because I'm greedy. Because when everybody's like, oh, China is this, then I was like, okay, let me see how I can make money out of this news, because market trades a lot on news, and a lot of the news are just noise that won't matter in the long run. So just using that basic rule that this thing has fallen, used to trade at like $20 a share, now it's trading at $8 a share because something went wrong, and you believe this company has a chance to still continue growing in the future, I want to buy. And trust me, you can buy and it still keep going down, and you always have to have the nerve for that. And which is why I don't look at a lot of these things every day, because you buy and it still keep going down. You're like, oh shit. But as long as you buy something that's profitable, that's going to continue growing in the future, you have little to worry about when you look at that same stock 2 years, 5 years from now. You would have made a lot of money out of it, typically, unless something just goes wrong. And that's why it's also good to diversify. Buy as many ones as you can. Don't put all your money, put all your eggs in one basket. It's true here. Like, don't put everything in one stock. Buy as many as you can, and mix and match them, because some of them would not do well. It's just the fact of life. But in general, because a lot of them will do well because you've done your homework very well, you will make money on a portfolio level.
So you talked about, doing your homework very well, but for someone who probably doesn't have any experience, investments and all of those things, what would be, what should we look out for, right? And what should be the next step? What should be the best step to actually take?
That's a good point. That's a good point, because I thought about that as well. And I said that earlier. Not everyone understand accounting. Not everybody understand, but at least have a knack for something that is good. And I'll just give you a good example, right? I use an Apple phone. I know this is a great company, right? Because they take my money every time I keep upgrading to new phone, or I'm paying for something on the app and they're taking a cut out of it. So for every transaction you're doing, on the app store. They're taking call out of it. I'm like, this is a no-brainer for me. This company is going to continue growing. And I don't even need to look at the financials, to be honest. And I'm not saying that that's always the right way to do it, but I'm saying I don't understand accounting. I don't know how to do all this financial analysis. I just want to buy a good company that I think is going to continue growing. So buy something that you believe will continue growing or you believe in. And that's why I say you've done some research, and your research might not necessarily mean your crunchy numbers. It's just basically your street sense that you know that, oh, this thing can make money. And it could be something in your own area of work as well. You work in healthcare and you know, like, oh, this company makes sense. Or even the company you're working for, like, oh, it makes sense. I want to buy the stock of that company. Or I've read about something about this bank, and I feel like they're doing something interesting and I want to own it. You know, Bank of America, you know, they have branches all over the place. They're doing well. But what I'm saying is when you go actually decide you want to do it, there's a lot of information out there too on your brokerage account. You know, look at them and read what people have to say about those stocks. And that's why I say you don't need to be an accounting genius or a finance expert to buy stocks and hold it for the long term. The problem is if you now want to be trading in and out, then you need some kind of technical expertise because you need to know when to buy and you need to know when to be selling. But if you just want to buy it and hold it for the long term, you don't need that much expertise. You don't need anybody to tell you go buy Apple stock because it's a good company and it's going to be growing for a long time. I'm sure many of us use Facebook, Instagram. That's a really good company. It's a great company. And they will just be doing the work for you, creating new ways of making advertising revenue, getting into new areas and keep growing. And as long as they keep growing, right? And that's my point. It's called value compounding. They're going to make you money over a long period of time. I'm not saying Facebook will necessarily make you money in 6 months. No, I mean, it might, but it might not, because you might be buying at exactly the time when one news is going to happen and the share price is going to drop. But if you buy Facebook 2 years ago, 5 years ago, go check it. You would have made money. And it's not because of anything, it's just because the company continues to deliver growth. And that's my point about the fact that don't bother yourself too much about, oh, I need to do all this research to the end and see all the accounting numbers and stuff. It's mostly with intuition, and also just don't buy crap. Don't buy a company that, you know, it's going to go bust. That's literally what you're trying to avoid. And that's why I said, just stick with the quality ones, with the quality growth companies. It could be in healthcare, it could be in tech, it could be in any industry, and just buy, or outsource that function to people and buy funds. And there's so many funds available out there as well on all of those platforms, and just buy a fund based on something you believe in. You know, you can believe in just trying to, like, for me, I like semiconductors right now because everything we're using are using chips. I like it. So I own a semiconductor fund, you know, and it's called SOX. I bought it. I mean, if you want to buy it, you can go buy it, but I own it. And I've made good money out of it, and I still own it because I like it. The day I just feel like, no, the chip industry, I don't believe in it, I'll sell it, right? But I don't own every individual semiconductor stocks in that portfolio. I didn't do that work, but I just bought the fund that tracks that thing. Does that make sense?
Yeah, thank you. So we have other questions.
Yeah.
So someone says retail traders are always not informed very well, like mainstream. Are there Facebook groups, portals that can be able to give us pointers or summary on markets and stocks? And then also, could you point us in the direction of groups, portals that can help give this early information?
Yeah, that's a good point. I mean, I generally don't, because I don't need them, I don't follow all those groups. But a lot of people say things out there that they don't know. So you also have to be careful following all those groups that they just say things to prop up their own portfolio, as opposed to trying to help you. And again, this platform, and I need to be very clear here, I'm not promoting retail trading. I actually don't trade too. So you could be speaking to the wrong person if you're trying to be trading stocks in and out, because I don't do it. And I don't believe in it. People do it, and they make money out of it, but it needs a different kind of expertise to be buying GameStop today and selling it in a week and cashing in on your gains very quickly. I don't do that. Maybe, I'm leaving money on the table, but that's not how I want to live my life. I don't want to spend a lot of time trying to figure out, what time am I going to sell it? Am I going to sell it tomorrow? I'm following all this group and people saying all this thing. I mean, Reddit has a lot of groups. You can, even if you get on YouTube, there's all this stuff. I don't know anyone to recommend to you because I don't do it. And the purpose of this is not to recommend you to start doing retail trading. Purpose of this is to try to communicate to you to build financial wealth. And building financial wealth is not really about trading stock. It's about investing in stocks. And investing means you have to be patient. It's not in months, it's in years. And that's when you start seeing the value of investing, because I've done it myself, so I know. You look back, you're like, oh, thank God I didn't leave that money in the bank account. That's what I'm trying to promote here. I'm not trading in and out, because if I trade out and I hold the cash, what am I going to do with the cash? Go buy a Ferrari? No. I want to still live it in stocks to grow the wealth over a long period of time. And so I wouldn't particularly tell you to go join any group to be telling you what to buy and what to sell, and be putting fear and all this stuff in you. Just, you can do that work yourself. But I'm not saying never, listen to other people too, because there's wisdom in having what others have to say. But I just want to be clear that I caution that don't get too wound into it and then start trading stocks very quickly and going in and out. And I'll tell you the reason for that towards the end of this presentation. I have something around trading short and long term.
Thank you for that. I think the name of the semiconductor ETF you mentioned was SOX, right?
Yes, SOX. SOX is the ETF.
Okay.
Yes, stocks. Yeah. But I mean, there might be other one. That's just the one I own. But there might be other ETFs. You can just go into your platform and type it in, and it will give you options of what's available. And that's what I mean by doing your research. It's just going in there and checking what's available, and then click on it, see what it has to say. What is the cost and all that stuff. How much is the what do you call it again? The fund expense and all that stuff. So just look at what you're buying before you buy it, right? And then read. It would even give you like the stocks inside the fund and all of those stuff. You can look at it and decide, okay, no, I don't want to do this, or decide if you want to do it. So yeah, but I just told you that, for me, I like semis. Yeah, but I have a tech fund, an ETF that tracks tech, QQQ. I own it. That's fine. So I have the S&P one. I just own all of this stuff. And to be honest, they're all making money. So it's like, at the end of the day, it's almost like I just diversify into so many things. There's some stocks that I own as well because I just believe in them. I mean, I use an Apple phone. I have Apple in my phone. I have a lot of tech companies. I have a tech bias because I just believe in them and I believe they will grow. And they've been doing that. You might necessarily not want to buy tech stocks. You might believe in other kinds of companies that will grow a lot in the future, but buy it. I mean, look at Moderna. Moderna came from nothing, and then this COVID thing, and they just using this mRNA technology, and look at them today. I don't own Moderna, I missed out, but that's a good one because you could actually have that information that, okay, they're using the technology. You don't need to know any accounting, like using the technology. And this technology can be used beyond just COVID vaccine. It could be used for cancer, it could be used for other sort of therapeutic purposes. And the company has been a blockbuster since this COVID started. So just putting out there like just things to like watch out for. So you can just be something you pick from the street and then convert it into an investment opportunity for yourself and then hold it for a long period of time. And that's why it's good to read about a lot of stuff, because that's where you actually get a lot of insight. It's not just dive into the financials alone. It's about just learning about new things going on. And okay, now everybody's talking about metaverse. What's that? Which companies are going to benefit from this? And then just maybe buy one of them and just hold it and see, Yeah.
But I think someone is raising up a hand, but then before that, the last question here is, what's your personal opinion on the future of EV companies? Looking at the trend, is it going to be viable in the long term?
Yeah, that's a good question, because we actually just had this debate in my company recently. No, I think EV is it's gonna be the next big thing. And our normal, ICE, which we call an internal combustible engine, which is most of the cars we drive today, are still going to be there. They're not going anywhere, but they're going to lose share, in my view, to EV. And it's just because of this whole global, there's a wave now for climate change, and as you all probably watch the same, news that I watch as well. There's a big move towards climate change, and EV just sits right in the middle of that, because the emissions from cars is actually one of the biggest contributors to the global warming. So there's a big move from the developed countries to move in that direction. Maybe not from the developing countries, but the developing countries don't really matter anyway, because they don't have that much money. So there's a big move, and it's now being done in a coordinated version that I believe that, it's the next big thing. And that's why you see Tesla stock. Tesla stock has gone busted. I didn't believe in it initially, because initially it wasn't profitable, but now Tesla is making money now. It's now profitable, because it's been able to scale. And I think this is just the beginning of that wave of electronic vehicles, just taking a lot of share from internal combustible engine vehicles in the world. So I do believe in it, and I believe that's a growth area. And I like this kind of question, because this is how I feel like you should be thinking about investing in stocks, right? You think about an idea, electronic vehicles, right? You do a research into it, right? Read as much as you can online. Instead of talking to some freaking guy in one retail trading platform, I believe a good use of time is actually doing the research about what is electronic vehicle and why is it so important? Why is everybody talking about it? And see whether this makes sense. Because, look at all these things I've told you about. Automobile emissions is one of the biggest contributors to global warming. All the governments of the developed countries across the world are worried about global warming and its impact. And we're seeing it now, with all these wildfires, flooding happening everywhere. So there's a big push for change. And part of that big push is there'll be subsidies to buying those cars. There'll be tax incentives to buy these cars. And some of these cars are cool too. I've driven a Tesla before. I don't own one, but I've driven a Tesla before. That's a pretty cool car. So I just feel like if you put all of those things together, it's just a no-brainer that this thing is going to happen. It's just at what path? I think the US is still kind of behind on the move, because you now need the infrastructure. You need charging points. And they also need to get a battery technology right, such that it can last longer. So I don't need to be charging the car like every freaking day, like I can still, or make it easier to charge, or maybe you can charge faster. And there's a lot of work going on behind the scenes, finding all this technology. So I believe it's going to work. And there's a coordinated effort globally for this to work. So if you can find good companies to buy for electronic, and you don't have to buy Tesla to have exposure to EVs. They are like other companies that manufacture components that they use in those vehicles. Those are also going to grow as well. So you see how to think about this. So you could now look for, okay, maybe Tesla is too expensive. I don't want to buy, it's what, I don't know what the price is now, or what's also amount per share. I don't want to do that. You could find some company in China that manufacture the batteries or manufacture some components that are used in those cars, because those are also going to grow in line with those EV growth.
Thank you for that. Anu, I think you wanted to say something.
No. I have a question. Thank you for your time, Mr. Tunde, so far. So the question I have is, first is not all of us on this call live, well, maybe I'm the only person. I don't live in North America.
Yeah.
Right. Well, all of these things you've mentioned are things that I can apply. However, my question is, how do I still invest in other countries? So specifically in my cases, I'm looking for opportunities to invest in some of these things you've mentioned in the US, right? But I understand the tax application is how will my tax be tracked and all those kind of things. So my question is, what are the options available to me such that outside of the index funds that I'm investing in here, how do I still invest?
Where are you? Are you in Nigeria?
I'm in the UK.
You're in the UK, okay.
Yes. How do I invest in the US, right? Bearing in mind this tax. That's the first question, right? The second question is, I've always had this wish. My niece and nephew is every year they're asking for something new. And after 1 month, they've forgotten about it. It's just useless. So I wasted my money. So is there, I've always had this idea in my head, like, is there a way I can buy stock options or something for them? And then as they grow older, it continues to yield profits. And when they're 18, they can take it over on their own. Are there any packages like that that I can read up, or all those kind of options available?
Yeah. So, thanks. So, I mean, you live in the UK, you can definitely invest in the US stock market. Absolutely.
Okay.
And I'll get you the, I have friends who live in the UK who trade stocks. So I can just text one of them and ask what platform they use. But it should be available to you. And I think the only difference is you just, you pay taxes based on UK tax law. That's it.
Okay, cool.
But yeah, they're definitely available to you. But I can get that information and send it to Yinka.
Prof, yeah, thank you so much. I appreciate that.
Yeah, and in terms of investing on behalf of your nieces, yeah, you can do that. You can create an account on behalf of them, but you will be the one
running it.
Yeah. There's definitely that option as well. And you can transfer it to them. They can take ownership when they're older. Yeah. I think all of these platforms have they have that option.
They have those options as well.
Yeah, they have those options too.
Oh, cool. Thank you. Thank you so much.
No problem. You're welcome. Any other question before I
no other questions for now, but I think someone is saying that you can try HI in the UK to trade US stocks. So yeah.
Which one?
HI.
HI, okay. Yeah, there are many. Yeah, UK, there's so many. I'm 100% sure there's so many options because I have.
Is it HI or HL? It's HL. That's Agris Lands Down. I use those guys already.
The boss saying actually type. Do you want to say something about that?
Yeah, I think it's Agris Lands Down. You mean?
Yes. So yeah, exactly. Yeah. So Agris Lands Down. If you use them already, you can buy US shares from that. Okay. So you can own Amazon, Facebook, whatever.
Yeah.
Thank you.
Thanks so much. Appreciate that.
Thank you.
Say it again.
You can continue. Yeah,
okay. All right. Cool. Yeah. So another one I want to talk about, and I know there might be some interest in that, is cryptocurrencies. It's new. It's a new thing for me too, but I've done a lot of reading into it. Because definitely they didn't teach me about crypto and CFA. So, we're all like, just exploring these new sort of asset class these days. But what is crypto? It's basically a virtual currency, but it's not a real currency in the sense of currency being a store value, like medium of exchange and all of those things we know about fiat money. But the real point of crypto is actually to be what fiat money is not, right? To be a pool of money that has limited supply, right? And because it has limited supply, it's going to create value over time. So they actually believe, or the people who innovated this idea, is they believe that we don't want to be bound by this fiat money, which is our US dollar, Naira, whatever, because what happens to that money is that over time it debases. And what I mean by debase is that they keep creating new money, right? So the Federal Reserve or the European Central Bank and all these just keep creating new supply of money. And what happens when you create new supply of money is existing money reduces in value. Because at the end of the day, the productivity of this whole world is not growing as fast as this new supply of money. And that's why we have inflation, right? So inflation is eating up all the fiat money, which is why I said initially, like, keeping your money in cash right now, it's not a good idea unless it's money you need to maintain your lifestyle, right? You need to buy something or pay your rent or whatever. For investment, you can't leave it in cash because it just doesn't make any sense. You're going to debase all this money away. That's the old genesis of cryptocurrency. And it uses a technology called blockchain technology, which is a distributed ledger. I have a big book here on Bitcoin, which I've read to understand this stuff, right? Because for me, I need to understand anything before I put my money into it. So I'm like, what is all this stuff? That's why if you've spoken to me last year, maybe I won't be able to have a conversation about crypto. But now I understand it more, and I think it makes sense. But the things I need to caution people about is that it's still very volatile because it's still early stage. And I mean, if you watch a lot of financial news, you will see it moves wildly. The swings is crazy. I mean, maybe Bitcoin is actually the least volatile one, but some of the other coins they move crazy. There's crazy swings. Sometimes in excess of 10% a day, like back and forth. So it can drive you nuts. Which is why if you want to do it, you have to have a knack for taking risk, and you have to have only a small percentage of your portfolio in it. Don't go big into crypto because it's still very volatile, and also partly because it's still early stage, and there's a lot of news that swings it around. Even recently, Elon Musk would tweet, and this thing will crash or it will move up crazy. So you got to be careful about that. But as an investment, I think it has a place, just because it fits into what you don't want for the fiat currency, which is what I talk about, money being debased over time. Bitcoin, for instance, has only 21 million in supply, right? And it's not going to go over that 21 million. And currently, they've mined, don't quote me on the number, but I think they've mined already maybe like close to 19 million. So there's 2 million left, right? And every, periodically, new set of coins keep getting created by all these miners and pushed into the system. And that has already been, the technology is already set on how that's going to happen. And I think by year 2100 or something, the whole 21 million is going to be exhausted, right? But the thing is, because there's scarcity of the amount of Bitcoin, and you can't create more than 21 million Bitcoin ever, right? So you have a limited supply. What could go very well for Bitcoin and all these other cryptocurrency is the fact that if it goes mainstream, and it's beginning to happen a little bit now, where institutional investors start putting some money into it. I mean, my company, we don't put money in Bitcoin yet. My clients will fire me if I try that. But I feel like over time, that could happen, and that will create a lot of money for people. In my view, this will create a huge amount of wealth for people in the future. So I think it's something for people to look into. But again, it's still early stage. It moves wildly. The volatility is crazy. So don't put too much money into it. And don't call my phone if you put money into it and it drops 20% next day. You'll be like, oh, don't cost me out. But I feel like it has the potential to be big because the whole concept makes sense. And it's just trying to be what gold used to be. And I've seen people do analysis how, Bitcoin is going to be $500,000 to one because all the money from gold is going to go into Bitcoin. I don't personally believe in that. I don't know what Bitcoin is going to go to. All I just know is that it has limited supply and the demand can go big. And it's just simple economics for me. If the supply is limited, so the scarce resource, and the demand is still where it is today, if that demand just shoots up by a little bit, even though it doesn't need a lot of demand to push the price up because the supply is limited, right? And that's why I said it's a good diversification strategy for your portfolio. And it's also interesting now that we're having inflation, because inflation is just another reminder that fiat money is really bad, right? Crypto has been getting a lot of attention, and you can see how, it crashed to around $30,000 sometimes in June or July. Now it's back to 65 or 66 now again. I'm not saying it's not going to crash again, but I think it has the potential to become very big, but I don't know what price it's going to be. It's just that the economics make sense. And if you're interested in it, I use Coinbase. I think that's what most people use. Go to Coinbase and you see a lot of coins. What I don't recommend is don't go and buy some coin developed by one dude in Texas, because now people are beginning to take advantage of this, and everybody's creating it because the technology is there. Blockchain technology can create freaking coin. I start telling all your friends to buy it. So there could be frauds around that too. So you got to be careful. Buy the established one. Go on Coinbase app or on go on their website, sign up, because you also need to put all your information, because the tax man also wants their money as well when you make money. So you can buy any of the coins. It doesn't have to be. Bitcoin is the most established one. The whole crypto market is about 2.5 trillion. Bitcoin alone is over 1 trillion. So Bitcoin is almost half of the whole thing. Ethereum is the second biggest one. That's around $500 billion market cap. So between both of them, it's already maybe 60, 2/3 of the crypto market. Those are the big ones. So at least those are the ones that are, there's all kinds, there's doggy coin, there's all these coins. Some of them are kind of joke to me and they move wildly, but the technology and the reasoning behind it makes sense, because I've done a lot of reading, and I would encourage you to buy a book. I have a book called Bitcoin Standard. You can buy it on Amazon. Read it yourself, so you know a lot about it before you even dive into it. Any question on crypto?
None for now, but I think you can just go on here because.
All right, let me go on quickly then. Yeah, I know Yinka mentioned that I should talk a little bit about agriculture, so I'll just touch a bit on this. I don't do agriculture, so just for the record, and because I don't believe in it. So for me, I think it's a bet on land value, in my view. It's not particularly whatever you want to do with it, whether animal farming or crop farming or whatever. Don't get me wrong, there are people who are farmers for a living. I just feel there's a low return investment, in my view. I've looked at agricultural companies all across the world. The return is low. And they also have biological risk. Weather or disease, pest, and all this stuff. So you need to manage a lot of other things. So it requires technical expertise to do it right. And you need skill, and it can be very volatile. Your return is out of your control, because it's commodity prices. You could be growing your soybean here, and then some guy in Brazil just grows way more, and the prices of soybean just crashes. So it's a lot of times government have to come in to subsidize it, because at the end of the day, we all still need to eat, right? So it's necessary. So we all somebody needs to do it. I just don't think my money should go into that when I can make better returns in other places. But I'm not generally saying that agriculture is crap or is meaningless. Again, I say we all still need to eat, and the population of the world is growing. I just don't see it as a high return asset class. And personally, I won't even venture into it, because history is a good lesson. And I've looked at a lot of agricultural companies globally, and they don't make big returns. So I would leave it at that, and just quickly talk about retirement plans, because I think this is very important, and this is something you can actually do today. You don't need to wait till you have money. So basically, if you leave, and again, I know somebody here is from the UK, so I didn't check into what sort of plans are in the UK. I don't know much about the UK market, but I initially thought this was just North America, and definitely US and Canada was my area of focus here, and I know their plans. So I'll start with the US, which is where you can either contribute to all these call it contribution plans, where you just take money out of your income every month and put it in it, and they have tax incentives because they don't tax it. So it's tax deferred plans, and so they don't tax your money, and you can grow it over time, and you even get you get a deduction from your taxes by doing it. But the most important thing is not even the tax element alone; it's the fact that you're actually investing and growing your money, right? So in the US, there are two types of plans. There's the traditional and the Roth. And the difference between the two is, for the traditional one, you take it out of your income gross and you invest it. And then you don't pay tax on it. But then you grow that wealth over time, but then you pay tax at the end. Whenever you retire and sell it, then you now pay tax at your tax rate at that time, right? So if you believe your tax rate in the future is going to be lower than today, then do traditional, right? Because it just makes sense in the fact that you pay a lower tax. But the difference, the Roth IRA, the difference in that one is that you pay the tax today. So you actually take it, is an after-tax contribution that you put in it, but then when you grow it over time, you're not paying tax at retirement. Most people do traditional. I do traditional as well, but why? I can't even explain, but that's the difference between the two. But either way, both will let you grow your investment over time. The monetary amount I put here is the limit that the tax authority allows you to contribute. So for the IRA investment retirement account is $6,000 a year. For the 401k plans is $19,500 a year you can contribute in it. I know it's not a lot of money, but you contribute it monthly. So if you divide 19,500 by 12, maybe that would be like, my math is getting rusty here. Inka, you can help me with your math skill here. But anyway, whatever it is per month, that's the maximum you can contribute in this. The good thing is a lot of employers actually match it 1-for-1, right? So not only are you contributing, your employer is also contributing into it, and then you just invest in it in a fund, in mutual funds or ETFs. Usually most employers will give you a list of funds you can choose. In my view, just choose the equity funds. Don't choose bond funds because you're not going to make any money on a bond fund. Just any of the equity mutual funds or ETFs that are equity funds, and just leave it in it, and you'll be amazed how much it grows over time. I mean, I have a lot of money in 401k, and I've only even worked in the US for 9 years, and it's big now, because besides the money I contributed, the money is growing every year. So it's just, and it's going to be my money when I don't know what age I'll be allowed to take it out. You take it out and then you pay tax on it at that time, because I have the traditional one. Pay tax on it, and the rest is yours. So the equivalent of that in Canada is the CRSP, and but Canada also has the other option, which is the equivalent of Roth, is a tax-free savings account. And the maximum in Canada is actually higher than the US. So you can actually contribute more in Canada into those plans tax-free than in the US. So definitely is something you should sign up for and do, because you're just going to be surprised how much it grows significantly over time. And, talking about building wealth. So besides your own personal stock portfolio and crypto and whatever, this is just another one doing some work for you on the side, just basically putting money to the side from your salary every month. And lastly is to talk about short-term and long-term investing. I know somebody asked about retail trading platforms earlier on. I'll just give you my view is generally always think long-term, because we're talking about wealth building and wealth generation here. And another thing to also consider is when you do short-term trading, you're actually incurring a lot of taxes because, I didn't do much research into the UK, but I bet if you Google it now, it's probably going to be the same thing. So short-term capital gains tax are generally higher. So in the US, for instance, they will tax you at your personal income tax rate. So if your personal income tax level is 30%, 40%, whatever, that's what you pay for trading in and out all the stocks. So short-term, based on the tax authority, is 12 months, so a year. So if you buy a stock and sell it within 12 months and make money, the tax man is going to be like, yeah, okay, give me my tax, and you're going to pay your personal income tax rate. So you're kind of losing money when you start trading up and down. Think you make money. That's why they're taxing it, but you incur a lot of taxes doing that. But the moment it crosses that 12-month mark, the capital gains tax drops significantly. So I have the numbers. If you earn less than $40,000 a year, which is a low amount, you pay zero. You don't pay anything once you can wait a year. If you make between $40,000 and $450,000, you pay 15% in the US now. And if more than $450,000 a year, you pay 20%, right? But even if you compare those rates to your personal income tax rate at those different income level, they're lower. So it always makes sense from a tax perspective to think long-term and wait long-term. Otherwise, you just be doing all this work and making money for Uncle Sam, giving a lot of it to the government as well, because the government is not stupid. They want some part of that benefit as well. So, but generally, I don't trade that much. When I buy things, I generally hold them for long, because that, in my own view, that's how you can actually gain a lot of benefit out of those investments rather than just trading them out. And especially for me, I'm going to be incurring too many taxes. Just trying to do that, so I just don't. So that's it. That's all I have, and I hope you guys find it useful. And if you have any more questions, you can shoot.
Thank you so much. We just have a last question here.
Okay.
So, what's your view on e-Naira?
Oh, e-Naira. Yeah. So it's a good idea. So they're trying to use the same concept as the crypto and blockchain technology to develop sort of electronic Naira, but it's still fiat money. It's not crypto. It's fiat money because it's still backed by the faith of the government, and they can create as many as they want. So it's not limited in supply. What I think is a good idea is that what they're trying to do with it is they're trying to promote financial inclusion. So they're trying to be able to reach people that don't have bank accounts and just want to get them involved into the digital economy. And it's going to be linked directly to the central bank. So it's almost like you have an account in the central bank and not directly with any bank. The risk there is that it could disintermediate all these banks and they become very irrelevant and they're going to lose out. So for that reason, the Central Bank of Nigeria has put a limit to it. So you can't be doing, a lot of money on e-Naira because they don't want all the, big money to start flowing through e-Naira. Then it will kill all the banks overnight, and they still want the banking system to exist. So it's literally for financial inclusion for the small man to be able to use it. And more importantly is that you wouldn't have those fees that generally comes with transacting normal bank account on those e-Naira. So it will be cheaper. It will be direct to the government. And also the government also are thinking, I think this is more long-term, to use it for government to people transfers. So let's say they want to do palliatives. I want to transfer to a lot of people. It will be easy, straight from the central bank, just directly into the wallet. So I think it's a good idea. I don't think it's going to be a game changer or earth shaking, but why not? You know, if you can get more people into the system to start transacting more easily, I think it's great. And I think a lot of countries in the world are also going in that direction. China has done it. Some other Caribbean countries are doing it as well. So I'm shocked Nigeria is actually at the forefront of that. So good.
Thank you for that. Then we have another question, probably the last question. And if we have more, I guess we'll just reach out to you.
No problem.
So yeah, someone says if I have 50K, that's $50,000 cash now. What would you advise on how to invest it, considering I have a mortgage?
Considering what?
Have a mortgage already.
Does it have a mortgage already? Okay. Yeah. So I would say if I have 50K, okay, good. I would put, I'm trying to be unbiased here. So I'll put a lot of it, let's say half of that in stocks, okay, like direct stocks, and I'll choose
stocks.
Yeah, I'll choose stocks, individual stocks. I'll put half of it in stocks, and I'll choose different stocks that I like. It could be Apple, Facebook, whatever, Tesla, Nvidia, or any of these good stuff that I like. I'll put it in it. I'll put around. I'll put another 30% in ETFs. So I said half in stocks, right? So that's 25K in stocks. I'll put 30% in ETFs, right? So that's 80% gone, right? And I'll put definitely I'll only do, so out of 50K, and if it's 50K, I'll actually put, and the person already has a real estate, so that's a big asset already. I'll put 10% of this in crypto. So 10% will be 5K. I'll put 5K in crypto, probably Bitcoin or Ethereum, any of the two, or maybe even split it into each of them, right? So the remaining 10%, so I said 50% in stock, 30% in ETF, 10% in crypto, and remaining 10% in maybe one mutual fund managed by Babatunde Ojo. I'm just kidding. You can put it in one mutual fund. So you just have that active risk, and because some of the managers like us, we bust our ass to try to make money for our clients as well. So buy an equity mutual fund. So I mean, if you notice, everything I've said is still kind of tied more into equity, just because this person has a real estate already. Because that'll be a good diversifier for this kind of assets you have already. But whoever is asking that question should make sure they have a retirement plan as well. Those 401k or CRSP plans as well. You should have that as well. So you have different ways of building wealth around. But don't leave that 50K in the bank account. It won't do much for you in the long run.
Thank you so much. I'm sure this was very insightful and informative for everyone. Thank you so much. How can we contact you? Because I'm sure some people still have questions.
You have questions? Yeah, you can contact me via my email. Is ojbabs@gmail.com.
Okay.
So it's OJ, not Ojo. If you put Ojo, you get a wrong email. So it's ojbabs@gmail.com.
ojbabs.
Yeah, gmail.com. Yeah, they can reach out and ask questions. Hopefully, it doesn't take me long to respond. I know Yinka will crucify me for that. I don't respond quickly because I'm too busy, but I will try as much as possible to respond.
Yeah. Thank you so much. This was really, really great. We're grateful that you were able to, bless us with your time and your knowledge.
Thanks for having me. Appreciate it. Okay. All right, everyone. Have a great rest of the evening.
Yeah. Bye.
All right, bye.
Thank you.
Thanks.
The members of the US Finance Group 1, please can you wait behind? Thank you. The US Finance Group 1.
Just about that members
You can sleep after all of this.
All right.
Let the Holy Spirit, speak to you on what investments to make.
You're still recording, so if you want to
Oh, sorry, I've been laughing since.